Imagine you've just inherited $50,000 or finally saved enough to invest seriously. You sit down at your desk, open your laptop, and immediately you're overwhelmed. Thousands of investment options stare back at you. Mutual funds, individual stocks, bonds, options, cryptocurrencies, real estate investment trusts. Every financial advisor you talk to seems to suggest something different. Every weekend financial news program screams about the next hot stock tip. You feel the pressure to make the perfect choice, to beat the market, to outsmart everyone else. But here's what we're going to show you today. The most powerful investing strategy might actually be the simplest one. And if you're interested in cutting through the noise and building real wealth, subscribe to this channel right now, because we break down complicated financial concepts into clarity. The Bogleheads 3-fund portfolio isn't flashy. It won't make for exciting dinner party conversation. Nobody's going to brag about their diversified index fund allocation at a cocktail party. But it works. It works so consistently, with such mathematical elegance, that understanding it could genuinely change your financial future. This strategy comes from the philosophy of John Bogle, the legendary founder of Vanguard, a man who spent his life proving that simplicity and low costs beat complexity and high fees every single time. Let's start with the fundamental problem that the 3-fund portfolio solves. Active trading and active management rest on a beautiful assumption that through skill, research, timing, and intelligence, you can pick investments that outperform the broader market. It sounds reasonable. It feels true. Wall Street depends on you believing it. But decades of academic research tell a different story. The vast majority of professional fund managers, people whose job is to beat the market, fail to do so consistently. Over a 20-year period, more than 80% of actively managed funds underperform simple index funds that track the entire market. That's not a lucky streak. That's not random. That's the mathematics of fees and market efficiency working against you. When you pay a fund manager 2% of your assets every single year, that 2% comes directly out of your returns. If the market goes up 10% and your fund manager's fees are 2%, you've essentially already lost 20% of your potential gains. To beat the market, your manager doesn't just need to match it. They need to beat it by enough to cover their fees, and then some. Most don't. Most can't. The math is simply against them. But here's where the Bogleheads philosophy changes everything. Instead of trying to beat the market, why not just be the market? The 3-fund portfolio accomplishes this through a beautifully simple approach. You divide your investing dollars across just 3 index funds. The first fund is a total domestic stock market index fund. This owns pieces of every single publicly traded company in the United States. When Apple, Microsoft, Tesla, and thousands of other companies do well, you benefit. When they struggle, you share in those struggles too. There's no picking winners or losers. There's no trying to predict which company will be the next big thing. You just own the entire market. The second component is an international stock market index fund. The global economy isn't contained within American borders. Companies all over Europe, Asia, and emerging markets are growing, innovating, and creating value. By owning an international index fund, you get exposure to those growth opportunities without needing to predict which specific countries or companies will outperform. You're diversifying your investment across different economies, different currencies, and different political systems. This is genuinely important risk management. The third and final piece is a bond index fund. Bonds are fundamentally different from stocks. When you own a stock, you own part of a company's future earnings and growth. When you own a bond, you're lending money to a government or corporation, and they're paying you interest. Bonds tend to be less volatile than stocks. They move differently. They provide stability, income, and a buffer during stock market downturns. For most investors, a combination of stocks and bonds is the right foundation for long-term wealth building. The genius of the 3-fund portfolio is that it forces you to think about your asset allocation, which is the real driver of your investment returns. Academic research shows that over 90% of the variation in investment returns comes from your overall asset allocation decision. Should you be 80% stocks and 20% bonds, 70 stocks, 30 bonds, 60-40? That choice matters far more than trying to pick the perfect individual fund or stock. Once you've decided your allocation, the three-fund portfolio lets you execute that decision with minimal costs, minimal complexity, and maximum diversification. Let's talk about costs, because this is where the real magic happens. An index fund typically charges between 0.03 and 0.2% in annual fees. That's $3 to $20 per $10,000 invested. A typical actively managed mutual fund might charge 1 to 2%. If you're investing $100,000, that's the difference between $300 to $200 versus $1,000 to $2,000 per year. Over a 40-year investing career, assuming your money grows as expected, those fee differences compound into tens of thousands or even hundreds of thousands of dollars in lost wealth. You might be thinking that sure, index funds cost less, but maybe you could find that rare manager who actually beats the market enough to make up for those higher fees. The problem is that past performance isn't predictive. Studies have found that top-performing fund managers in one period often become average or below-average performers in the next period. It's basically impossible to identify in advance which managers will outperform. You might get lucky. Some investors do find a manager who beats the market for a while, but it's like winning the lottery. You can't reliably predict it, and you certainly can't count on it for your entire retirement. This is why the Bogleheads philosophy emphasizes what they call the set it and forget it approach. You decide your three-fund allocation based on your age, your risk tolerance, and your time horizon. If you're 30 years old with 40 years until retirement, you might go 90% stocks and 10% bonds. If you're 55 years old, you might prefer 60% stocks and 40% bonds. If you're retired, you might be 30% stocks and 70% bonds. The exact allocation matters less than the fact that you've thought about it deliberately and that it matches your life circumstances. Once you've set your allocation, you stick with it. You don't try to time the market. You don't panic sell when stocks fall. You don't get greedy and overweight stocks when everything's rising. Instead, you invest consistently, perhaps monthly or every time you get paid. This is called dollar cost averaging, and it's one of the most powerful wealth-building tools available. When the market is expensive, your regular investment buys fewer shares. When the market crashes and becomes cheap, your regular investment buys more shares. Over time, this smooths out market volatility and protects you from the emotional mistake of investing all your money at the market peak. Every year, or maybe every few years, you rebalance your portfolio. If your stock allocation has grown to 95% because stocks have outperformed bonds, you sell some stocks and buy bonds to bring yourself back to your target allocation. This forces you to sell high and buy low in a systematic way. It removes emotion from the process. It sounds simple because it is simple, and that simplicity is the entire point. Simplicity means lower costs, fewer mistakes, less emotional decision-making, and more time focused on what actually matters in building wealth, earning money, saving money, and investing consistently. Let's look at a concrete example to see how this plays out over time. Imagine you start with $100,000 at age 35, you set your allocation at 80% stocks, 20% bonds, and you commit to investing an additional $500 every single month. The stock market will rise some years and fall other years. There will be periods when your portfolio is up 20% and you'll feel great. There will be years when it's down 15% and you'll feel anxious. But if you follow the Bogleheads philosophy, you stay the course. You don't let fear or greed dictate your actions. You trust the math. You like this video if you're finding this information valuable, because understanding these principles is genuinely one of the best financial educations you can get. Over 30 years, assuming average market returns of about 7% annually for stocks and 3% for bonds, your portfolio might grow to over $1.2 million. That assumes you never beat the market, never pick a winning stock, never make a brilliant timing decision. You just own the market and stay disciplined. More importantly, someone trying to actively trade and beat the market would need to beat the market by about 3% annually just to break even with you after fees. That's an incredibly high bar. Some years they might succeed. The three-fund portfolio also provides something that active trading can't: psychological peace. You're not checking your portfolio daily. You're not reading financial news obsessively, trying to spot the next opportunity or threat. You're not staying up at night worried about whether you picked the right stocks. Instead, you've created a system that's aligned with how markets actually work. You're not fighting the market. You've become the market. This peace of mind has real value. It keeps you focused on the things you can actually control: your income, your savings rate, your expenses, and your discipline. Now, we should address the common objections because people resist the three-fund portfolio for various reasons. Some say that index funds are boring and they want excitement from their investments. That's fine. If you absolutely must pick individual stocks, most financial advisors suggest limiting this to no more than 5 to 10% of your portfolio. Use the three-fund portfolio as your stable core, and then gamble with a small amount if you must. But understand that you're gambling. You're not investing. The evidence is overwhelming that individual stock picking hurts most investors' long-term returns. Others worry that index funds are lazy and that they should be more active in managing their money. But that's backwards. Index funds are incredibly smart. They're the result of decades of academic research and financial innovation. They're used by the most sophisticated investors in the world. Warren Buffett himself, one of the greatest investors ever, recommends index funds for most people. He even specified in his will that the bulk of his wife's inheritance should be in index funds. If it's good enough for Warren Buffett, it's probably good enough for you. Some people fear that their three-fund portfolio won't give them an edge, that everyone's doing it, so how will they get rich faster than everyone else? But that's a misunderstanding of what investing actually is. Investing isn't a race. It's not about getting rich faster than your neighbor. It's about getting rich, period. It's about accumulating assets that generate wealth. If the three-fund portfolio takes you from $100,000 to $1.2 million over 30 years, that's not a failure just because someone else also became a millionaire. You both won. You both accumulated wealth. The difference is you did it without ulcers, without fees eating into your returns, and without the psychological toll of constantly second-guessing your decisions. There's also the matter of simplicity for life planning. With only 3 funds, you can easily calculate your total net worth. You know exactly what percentage of your assets are in stocks versus bonds. You can adjust your allocation as you age without complexity. You can explain your investment strategy to a spouse, a financial advisor, or even a child in minutes. That clarity is powerful. It means you're less likely to panic when markets move because you understand why you own what you own. The historical evidence for the three-fund portfolio is extensive. We have data from decades of market cycles, including major crashes, wars, recessions, and booms. Through all of it, investors who simply owned diversified index funds and stayed disciplined outperformed the vast majority of active traders and active managers. This isn't just theoretical. You can look at specific studies from firms like Morningstar, which tracks mutual fund performance year after year. The percentage of active funds beating their index benchmarks after fees is consistently in the 20% range. That means 80% are losing to the index. We should also talk about how your three-fund allocation changes as you age. The classic rule of thumb is to subtract your age from 100, and that gives you the percentage that should be in stocks. By that logic, a 30-year-old would be 70% in stocks. A 45-year-old would be 55% in stocks. This makes sense because younger investors have time to recover from market downturns, while older investors need stability and income. Some investors prefer a more aggressive allocation throughout their lives, and that's reasonable if they have the psychological constitution for it and won't panic sell during crashes. What's crucial to understand is that the three-fund portfolio is flexible. It's not dogmatic. Some investors tweak it to include a small percentage in real estate investment trusts or commodities. Others stick strictly to the three funds. The important principles are diversification, low costs, and behavioral discipline. Those principles work, whether you're following the three-fund portfolio exactly or a slight variation of it. The worst thing you could do is abandon these principles because you think you found a way to beat the market. Let's discuss one more critical concept: tax efficiency. When you trade actively, you're constantly buying and selling, which creates capital gains that you have to pay taxes on. Index funds, particularly when held in tax-advantaged accounts, like a 401k or an IRA, create minimal tax liability. This is another hidden way that the three-fund portfolio outperforms active trading. You're not just avoiding high fees, you're also avoiding unnecessary taxes. Over a lifetime, this could easily add hundreds of thousands of dollars to your wealth.